Hey, Bulls and Bears, we are back with another dose of economic reality. Let's get right into it. Let's talk about what CEO of Bank of America said. That's Brian Moynihan. And this is something we've been hinting at that's going to happen for a long time. But according to the CEO here out of Bank of America, this is happening now. So, what does he see at his bank? Take a listen. Bank of America, I'm just going to read you the headline first, then we'll get into kind of more about what he said here. Out of Fortune, Bank of America warned consumers they would be pushed to the quote, point of pain, unquote. CEO Brian Moynihan. And he says, we've now reached that point. It's a message now echoing in every corner of Wall Street. Consumers have finally run out of steam. Remember a month or two ago, we had these reports that came out that said consumers were going to run out of money by October. It really didn't say that. It says consumers were going to run out of excess savings by October. So we've now reached that point. But even before this, we knew that most people were living paycheck to paycheck. People didn't have much excess savings to begin with. However, starting in 2020, people got a boost in their savings because of all the shutdowns and the freezes of the payments, all the rescue programs. Of course, some of the stimulus checks that were sent out had a part in that as well. But that money's spent, that money's gone. The cost of living's evaporating households' purchasing power and also evaporating their savings. It's also an eventuality Bank of America has predicted since March, when analysts warned the Fed would push consumers to the point of pain in order to tame inflation. He was on Squawk on the Street, CNBC show. Moynihan said the way consumers are acting is consistent with a low growth, low inflation economy. It's not really a low inflation economy, but he said it's consistent with that. In a given year, Bank of America customers spend $4 trillion, be it using a debit or credit card, writing a check, confirming a bank transfer, or taking cash out to spend. From 2021 to 2022, that grew by 10% and began dropping to 9% in the first quarter 2023. Now, that figure has dropped to 4.5%, signaling consumers are either too nervous to spend the money they have or less than their pandemic-boosted savings amount to sustain their spending level. So a lot of signs out there, folks. We're headed for some real tough economic times. The central bank out there, Powell was out there again talking about the need to keep rates higher for longer, and the market reacted to that. We saw stocks go down. We saw bond yields rise. In fact, take a look at some of the latest numbers here. All indices in the red today, by the way. Oil up over $90 again. Gold, a little bit of a bump there, $1,990. Silver, a bit of a bump, $23.20. The 10-year bond right at about 5% as I'm reading this. And we know that that has a correlation to mortgage rates. In fact, let's take a look at what mortgage rates did here just recently. The Mortgage News Daily Index hit 8% today. That's the highest, folks, the highest in 23 years. Other signs that the economy is not doing so good. We have the world's largest chip maker out of Taiwan sees the biggest drop in profit in nearly 5 years. But I thought the consumers were strong, right? Everybody's out there shopping nonstop. Then why is the world's largest chip maker seeing the biggest drop in profit in nearly 5 years? China's real estate bubble is absolutely collapsing. In 2008, when the subprime mortgage crisis nearly ended modern capitalism, housing was 8% of US GDP, while housing is 25% of China's. This is an epic meltdown, and it's just the beginning. Meanwhile, in the United States, inflation is so high that the Federal Reserve is talking about raising interest rates further, choking the credit out of the economy completely. Everything is expensive. Gold is perfect for this environment, but it is at near all-time highs already. So I want to present a company called Gold Mining Inc., trading on the New York Stock Exchange under the ticker GLDG. The reason is that this company trades at multi-year lows, extremely cheap. Their gold resources are only worth $1 per ounce. If you go to wealthresearchgroup.com/cheapgold, there's an entire presentation explaining how this company is effectively 80 or 90% more discounted than anything out there. If you're bullish on gold, I urge you to stop everything you're doing and download this carefully drafted report now. Gold Mining Inc. is a junior resource company trading under the symbol GOLD on the TSX Venture Exchange and GLDLF on the OTC markets. The company is focused on the acquisition, exploration, and development of resource stage gold projects in the Americas. Goldmining.com. Link down in the description of this video. It doesn't really add up, does it? So consumers are either tapped out or on their way to getting tapped out. People are starting to realize it. They're starting to get nervous. One thing about people and spending money is typically they don't start to worry or get concerned until it's really close to the end or financial ruin, right? I think that's just the way that some people just choose to block out certain things, right? But if the world's largest chip maker is seeing a drop in profit, that's electronics that are not getting bought. Let's see, do they make vehicle chips here? Taiwan Semiconductor Manufacturing Company. Okay, mostly electronics, consumer electronics. People are starting to pull back on that type of spending. When I say that type of spending, I mean discretionary things that people don't have to have, right? So less of wants and more of the needs, and the things that people need, you're going to be paying more and getting less. And that's the sad truth about what's going on here. And there's not really many signs of that reversing anytime soon. And we think, Powell made that clear. Of course, the markets didn't like that. One thing about the stock market, if easy money becomes not so easy, then typically you see the stock market stop making all-time highs. And we told you right here at the end of 2021, early 2022's, early 2022, that those highs were not going to be surpassed until we saw massive rate cuts. So will we see emergency rate cuts? Who knows? But for now, with the Fed out there job owning the markets are going to continue to go down. And I think they're afraid to really say anything about cutting rates because they've put this line out there that the economy's strong, the economy's good, consumer strong. That's been debunked now. We've debunked it here, but now even Bank of America CEO is admitting that, but we debunked that here for years, that the consumer's not strong, living paycheck to paycheck. Because people can borrow money, though, that's been perceived as strength, economic strength, right? When people borrow money, spend money, even borrowed money, it gets chalked up as gross domestic product, and they put that out there as the number, one of the key gauges of the economy, and everybody looks at that and they say, wow, this economy is doing great. Another headline here out of CNBC, something that's finally being talked about, but we've been talking about it here for a long time. Big banks are quietly cutting thousands of employees and more layoffs are coming. Well, it's not been so quiet. If you just look at certain news topics, you know about the layoffs. A lot of them were concentrated in the tech industry, but a lot of bank layoffs have already been happening. But it is good to see some of the mainstream news, talking about this. But if you look at the mainstream news channels, the business news, I really don't see a lot of talk about that. It's mostly rah, the economy's doing great. Look at the unemployment number. In the meantime, we've got close to 100 million people out of the labor force, folks. So that's how they can justify that low unemployment rate. Americans need Americans need $658,000 to retire. That is a recent study. So you're 65, maybe you'll live another 20, 30 years, and you're going to need $658,000 to retire, to basically not run out of money before you run out of breaths, for lack of a better term. That's pretty sad. Wow, $658,000. That's a pretty big 401k to save up, by the time you retire. I know some people that are 67, 68, and still afraid to retire. I think for that reason. Now, to me, that seems pretty excessive. If you live a low-cost lifestyle, it seems to me you could get by through retirement without $658,000. But that's what's being reported. Where was this study at here? That was by a finance guide called MoneyZine. They crunched the numbers on a state-by-state basis. Some states worse, some states not so bad, but that was kind of the median or the average that people would need in all the different states. Now listen to this. Speaking of consumers that are in big, big trouble, and to go along with what the Bank of America CEO said, listen to this. family health insurance now through work, through someone's job, costs $24,000 a year. That's up 7% from last year. So about $2,000 a month. Now, hopefully, if you have a good employer with good benefits, the employer is going to pay a big chunk or most of that. That's true, I think, on a lot of big companies. They kind of chip in with the employee, but $24,000 a year total, that's up 7%. Wow. So again, a number that is above the official inflation rate, the CPI number, which is 3.7. It's hard to look at anything and see it up less than 7% year over year. Now, finally, home prices have stopped growing so much where it's much less than 7% year over year. In fact, if you look at the top 20 cities, home prices are pretty much flat and even down from last year. So we're seeing some year over year numbers dropping. Now, a lot of people are getting discouraged when it comes to certain markets, including the real estate housing market, because they expected prices to come down a lot faster. Well, just the fact that they're not up, because remember, we saw price growth that was double digits for several years, year over year numbers, double digits. So to see them near zero and even slightly negative is a pretty big change, even though a lot of people did expect it to be a lot worse, or they expected the market to come down a lot faster, considering the magnitude of the rate increases. But you have to have patience in these markets. This is a slow moving market. We've always said here that it's going to be a slow motion collapse. Now, could there be a moment where everything implodes? Absolutely. I mean, look at the debt markets, look at the hundreds of trillions in derivatives. The derivative book for these banks, even if you just look at the big mega banks, the derivative book is larger than the U.S. national debt. Some banks have even close to what the U.S. national debt is, just a single bank. But you take all the banks as a whole, it's hundreds of trillions of dollars. I mean, it's numbers so large, it's unimaginable. Imagine how much different the cost of living would be if banks were to stick to guidelines and stick to only loaning out money they have. And then to take it a step further, imagine if we had sound money. Imagine if money can only be issued if you had gold and silver to back it. Right? Think about that. You'd also see little, if no, wars, because you couldn't just conjure money out of thin air to go to war. And, that would make things a lot different. It would make the world a lot better, if you ask me. Let's get into some other news here real quick. A financial crisis is here. U.S. banks are closing down hundreds of branches and laying off thousands of workers. Folks, just at the beginning of this month, we had 21 Bank of America branches close. Wells Fargo, 15 closed. Some 54 locations had either closed or were scheduled to close between October 1st and October 7th. Folks, what is going on? We've never seen banks close branches this fast. Now, some people say this is just a continuation to the digital method of money, online transactions, people pay their bills online, etc. Less people needing to go into branches. Well, we've had online banking for 30 years now, maybe more. Back in the 90s, I mean, the websites were pretty lame if they had websites, but it's been around for decades, bottom line. Why now? Why are we seeing this sudden explosion and increase in number of bank branches closing? Again, online banking has been around for decades. So that's what's being talked about in a lot of the news, the business news is, oh, it's online banking. Well, of course, it's online banking is part of it, but online banking is not new. Internet didn't just come out last week. So something's going on. These banks are closing much faster than we had seen previously. So something to keep an eye on, folks. A lot of things could be brewing behind the scenes that we're not familiar with. A lot of things that happened previously, if you look at history, they've been kind of in the dark and covered up until, boom, one day the financial crisis hits, another big bank fails. More bank failures are ahead, folks. The books of loans, the bonds that these banks are holding are severely they've severely lost value with the higher interest rate environment. Those yields at 2-3% that we saw for 10, 15 years are now coming back to bite the banks. Again, none of these banks braced for a higher rate environment. They always had assumed that rates would just either stay low or that the Fed would start cutting rates as soon as signs of trouble emerged, like bank failures, for example. Well, the problem is the Fed isn't doing that because they now have this fight against the cost of living that people can see every day with their own eyes. So they're painted in a corner, folks. All right, so we're going to wrap this one up here. What do you think about today's news? Please let me know what you think down in comments. Otherwise, keep stacking. Hope everybody's well. Talk to you very soon. Bye.